right, everybody. Today we're going to talk about something that I use every time we gap up, and it's helped me really feel comfortable trading gap ups. Gap ups are usually when price the day after opens up above where we closed the previous day, and it often is a fairly tricky environment to trade in because you're unsure if the gap up will get filled before it pushes higher, or if the gap up gets filled and we push lower. And so what I'm going to give you are a few different rules around what to look for. Okay, so what we're looking at here is a real nice gap up that we saw. We saw a nice little close around the 600, and the day after we gapped up, opened up around 6641. So how do we trade this? Right, so it's important to let the first 10-minute candle develop. And once it's developed, you can mark the highs and the lows. The way I usually do it is, with a rectangle, and that way you'll understand what the range is, right? You can see that the range of the first 10-minute candle low is 6639 and the high 6670. And so in simple terms, if price moves below the first 10-minute candle range low and is unable to push back into this range, it's more likely than not that we can get a gap fill. If price pushes above the first 10-minute candle low high, then we could get a trend higher. So I remember trading this, and this is exactly how I did it. We opened up, pushed higher, came back down, and then the next candle, you can see that we peaked back below that first 10-minute candle low, and we're unable to see a consistent kind of close below, right? We closed here, and then on the next 10-minute candle, we saw a nice little rinse that got bought up, and it closed near the highs inside of this orange rectangle, right? Inside the middle of this first 10-minute candle on the 10-minute chart. And the next few candles, you can see what happened, right? We tested and probed the highs of this range until we broke through. Once we broke through, we saw a nice little trend day higher. This is exactly how I trade it. This is exactly the things that you have to look for. Looking over here to the right, I already drew the first 10-minute range. You can see here that it's a little bit opposite than before. We gapped up and we saw a little bit of a pullback and then push. And then we saw a nice little trending candle through that 10-minute high, but slammed down, right? Huge engulfing candle all the way back below this range, which is very bearish. But look what happened next. We were unable to sustain a close below the range, and we saw 3 10-minute candles where buyers stepped in here, here, and here. So here your bias is, and the way you could trade this is, you can go long with your stop below the candle low here. Because the idea is that, let's say you enter at 67.86. Your stop could be at 83. You have 3 points down versus potential trend day higher, which is what happened in this case, right? But we don't know this is going to happen, right? So you have to set yourself up. Knowing this, we can set ourselves up for that kind of success. And I lost that day over here. There we go, right? So basically, psychologically, what's happening here is that we're gapping up, and it could be on anything. You have a nice little high and low that you look for. And that way you have a reference that you can look for as you're trading. And you know that if you're above, it's likely a trend day higher. If it fails, then it's likely a gap fill. If it's inside of this range, it's chop, right? In this instance, really ugly candle low should have seen continuation, but it did not. So that's your first sign. I was like, okay, there are buyers here ready to bid this one up. And look what happened. Over the next half an hour or so, every candle had a nice little wick on the bottom that got bought up, and we pushed in above this range and saw traction for a trend day higher. Same playbook. Once again, over here, we saw a nice little gap up, not a huge gap up, nonetheless a gap up, right? You mark the high and the low of the first 10-minute candle. Your expectations is simply, if price moves below, you want to see continuation to fill the gap. If that fails, you're anticipating a push back up to the top of this range. And if broken and sustained, you could see a nice trend day higher. And lastly here, just in order to keep this video fairly short and just, it's not a very complicated concept. Here's another example where the attempt to push higher failed, right? So the last three examples, we talked about how buyers stepped in exactly where they had to. And in this instance, it's a very small gap up, and the every attempt to push higher got sold into. You can see that due to the wicks on the 10-minute candles over here, right? Just sellers piling in. Every time we push higher, they pile in and they sell into the strength. Eventually, look what happens, right? They fill the gap, and obviously, as per gap rules, once you get a gap fill, you expect a bounce. We saw that, but that failed until we did not, right? Until, look what happened over here in this candle. So what I could have done is done this, right? And this is the 11:20 a.m. 10-minute candle, right? So in the morning, we tried pushing higher, failed, we gap filled, we attempted to push below the previous day low, we failed, and then bull stepped in here with a huge green candle that pushed all the way up to the top of this range, and then eventually finally broke through, and we saw a nice little trend day all day long. Please note this over here. This is a real nice check back, and when you have a push higher and then a pullback, you do not want this range high to break, right? You don't want price to close inside of this orange box, right? And in this instance, we did not. The check back was right above. So when you see that, it just says that the buyers are stepping in at higher prices, which is bullish. And that could have given you a secondary entry for a long. The time frame I watch these things on is the 10-minute time frame. That's what we're looking at here. We are marking the bottom and the top of the first 10-minute candle. We're using that range as a reference. If price moves above, we could see a trend day higher, and that gap up could be sustained. If price moves below, it's a little more bearish. You want to see bulls stepping in to push it back up higher. If not, they might see a gap fill, in which you have to look at some of the other gap rules that will allow you to trade that kind of thing, right? So a gap fill, you're expecting the bounce. If it fails to bounce, you can see a bigger push lower. And then once we break the top of this range, you're expecting a trend day, meaning every dip could get bought into the close. So hopefully that took away a little bit of that kind of mystery with gap ups. I know a lot of you guys could feel a little nervous with gap ups, and I do too. I'm always a little more cautious. But ever since I created this framework for myself to trade within, it's helped me tremendously to stay within it and trade what I see rather than being too emotional about what could happen, what could not. So having this framework has helped me tremendously. It's actually helped me catch some of these moves that I actually just showed, and it's been tremendously profitable throughout the last few years that I've implemented this. So if this video was very helpful for you, make sure to like the video, help me out, repost it, and if you have a comment or a question, just drop it below and I'll make sure to respond. Okay? With that, thanks so much and take care. Bye.